Welcome to the deep dive. This is where we try to, cut through the jargon, find the really interesting stuff, and help you get properly informed. Today, we're going to pull back the curtain on a part of finance that, okay, maybe sounds a little dry. But trust me, what we're digging into is absolutely key to how companies actually work and honestly to understanding your own paycheck better. We're doing a deep dive today into employee related liabilities. Think of them as the hidden gears, maybe, in the financial engine room. They make sure people get paid and that companies, well, meet all their tax and benefit duties. Our mission is not just to list these things, but to kind of expose the financial leverage points they represent. We'll uncover some surprising bits, like how a standard benefit might quietly ramp up a company's debt, or why giving a bonus isn't quite as simple on the books as you might think. And before we get really stuck in, just a quick reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we'll discuss come from the accounting resources over at farhatlectures.com. So if you're an accounting student, maybe studying for the CPA, or already a professional, definitely check out the website. They've got extra practice questions, video lectures, loads of support to back up what we talk about today.
Big thanks to Professor Farhat for making this material available.
Okay, so let's imagine someone, let's call her Alex. She's just launched her own small design firm, super excited, hires her first employees, and then the first payroll statement lands. And it's not just salaries, right? There's this whole other layer of costs, obligations. So today, we're kind of following Alex's journey, breaking down these employee-related liabilities, all the financial promises companies make that go beyond just the basic wage. Things like wages, benefits, all those deductions, they add up. It's a really significant chunk of a company's running costs, often more than people realize.
Absolutely.
Yeah.
And that's where getting the accounting right is just so vital. For Alex, or any business really, keeping accurate track of these isn't just, good housekeeping. It's fundamental for staying compliant with all the laws and, frankly, for the company's financial stability. If you mess these up, you could be looking at serious legal trouble, big fines, maybe even major cash flow headaches. It's a core part of running a business.
Okay, so with that overview, let's zoom in on the bit most of us see directly those lines on our pay stub. We're talking payroll deductions. When you see your gross pay and then your net pay, what's actually happening in between?
Well, simply put, payroll deductions are amounts your employer withholds from your gross earnings before you get paid.
Right, stuff like federal and state income tax, FICA, that's Social Security and Medicare, maybe health insurance premiums, 401k contributions, union dues for some folks. The list can be pretty long.
It can. And from the employer's perspective, the accounting treatment here is really interesting. They record these withheld amounts as current liabilities.
Okay, why liabilities?
Because the employer isn't keeping that cash. They're essentially acting like a collection agent. They hold the money temporarily, but it actually belongs to someone else, the government, the insurance company, the union, whoever. So they have this short-term obligation, a liability to pass that money on, usually pretty quickly, within days or weeks.
That makes sense. So let's use Alex's firm again. Say her weekly payroll is $10,000 gross, and maybe $13,320 is held back for income tax, $765 for FICA, maybe $88 for union dues. That total, what is that? $2,173. Alex doesn't keep it. It's logged as a promise, a liability to pay those amounts out to the proper places.
Exactly. And this brings us to a really crucial point, something that often trips people up, even those who've been in business a while. These specific deductions, the ones taken from the employee's gross pay. For the employer, they are liabilities, yes, but they are not expenses.
Ah, okay. That's a key distinction.
It really is. The expense for Alex's company is the gross pay itself, the full $10,000 in our example. The deductions are just money passing through their hands on its way somewhere else. It affects their cash flow temporarily, sure, but it doesn't hit their income statement as an expense, only their balance sheet as a liability.
Okay, got it. So that's what comes out of the paycheck. But what about the money the employer pays on top of your salary, the extra costs they bear? That leads us to the next big category, right? Payroll taxes.
Indeed. And the important thing to grasp here is that payroll taxes, well, they're often a two-way street. They're imposed on both the employer and the employee. So while some parts are deducted from your pay, the employer often have their own matching share to pay. And that part, that absolutely is an expense for the company.
Right. Let's break down the big ones. FICA, Social Security, and Medicare. So for Social Security, the official name is OASDI.
Old age, survivors, and disability insurance. Quite a mouthful.
Yeah. So the employee pays, 6.2% of their gross pay, but only up to a certain income limit each year. That limit changes, but let's use roughly $142,800 as an example. But Here's the kicker that maybe not everyone clocks. The employer pays another 6.2%. They match it.
That's right. So that 6.2% you see coming out for Social Security, your employer is paying the exact same amount on their side. It totals 12.4% going towards that benefit.
And then there's Medicare. Employee pays 1.45%, and there's no income limit on that one, right?
Correct. No limit on Medicare. And again, the employer matches it, another 1.45%.
So a total of 2.9% for Medicare. It really highlights how the cost of employing someone is significantly more than just their base salary. That matching is a big deal.
It absolutely is. And accounting-wise, that employer portion of FICA is treated differently than the employee's deduction, the employer's share. That gets recorded as a payroll tax expense on their income statement.
Yeah.
And of course, also as a current liability on the balance sheet until they actually pay it to the government. It's a direct hit to their bottom line.
Okay, so FICA is a shared burden. What else falls under employer payroll taxes? Unemployment taxes.
Yep, exactly. You've got FUTA, Federal Unemployment Tax Act, and CETA State Unemployment Tax Act.
And their purpose is basically to fund the unemployment insurance system, right? The safety net if someone loses their job.
Correct. Now, the interesting things here, FUTA is usually a pretty small percentage, maybe 0.6%, and typically only on the first $7,000 of wages per employee per year. That's after a credit most states get. CETA, though, that varies a lot state by state. And states often give lower rates to companies that have stable employment, fewer layoffs. It's an incentive.
Ah, clever.
And crucially, both FUTA and CETA are employer-only expenses. You, as the employee, never see these deducted from your paycheck. It's purely a cost the business has to cover.
Okay, let's bring that back to Alex's $10,000 weekly payroll example. So we know her employer FICA share is 7.65%. That's the 6.2% Social Security plus 1.45% Medicare. Let's say FUTA is 0.8% for her situation, and SUTA in her state is maybe 4%. So her total payroll tax expense for that week would be 7.65 plus 0.8 plus 4. That's 12.45% on $10,000, so $1,245.
That sounds right. $12,245. And remember, that's entirely separate from the deductions withheld from employees. It's an additional cost, straight onto Alex's expense report.
Wow, okay. You can really see how these hidden costs start to pile up for a business owner. All right, let's unpack this even further, because it's not just about the paycheck itself or even the direct taxes. What about things like paid time off, vacation days, sick leave? How does that work on the books?
Oh, yes. That brings us to compensated absences. This covers basically any paid time off the company gives employees. Could be for vacations, illness, holidays, jury duty, parental leave, you name it. It's a really significant part of the total compensation package these days.
Definitely. So how do companies account for it? Is it an expense when the employee takes the day off?
Not exactly. It's a bit more complicated thanks to GAAP, generally accepted accounting principles. Under GAAP, a company actually has to accrue a liability for compensated absences, but only if all 4 specific conditions are met.
Okay, what are the conditions?
1. The company's obligation relates to services the employees have already provided. 2. The employee's rights to receive pay for this time off either vest or accumulate. We'll unpack those terms in a sec. 3. Payment is probable. And 4. The amount can be reasonably estimated. If all 4 are true, they have to book a liability before the time is even taken.
Okay, hold on. Vest versus accumulate. That sounds important. What's the difference there?
It's a crucial distinction. Vested rights mean the employee gets paid for that time off, even if they leave the company. Think of it like earned money they're guaranteed to receive. If rights are vested, the company must accrue that liability.
Okay, vested is like a guarantee.
Right. Accumulated rights, on the other hand, means the time off carries over to future periods if unused. But the employee might not get paid for it if they leave. So they can bank the time, but payout upon termination isn't guaranteed.
So for accumulated rights, do they still accrue a liability?
Yes, they generally still accrue it, because payment is probable if the employee stays and uses the time. But they might adjust the accrual based on expected forfeitures people leaving without using the time.
Interesting nuance there.
And typically, companies accrue these liabilities based on the employee's current rate of pay at the time the liability is recorded.
Which means the cost could go up later, right?
Exactly. Let's walk through that with a vacation pay example.
Okay.
Say Alex has 10 employees, each earning $480 a week. And during 2025, they collectively earn but don't use 20 weeks of vacation time. Let's assume these rights are vested. So Alex's company meets the GAAP conditions. They need to accrue a liability in 2025. That would be 20 weeks times $480 per week. which is $9,600. They'd record $9,600 as vacation expense and $9,600 as vacation payable in 2025.
Okay, so the liability is on the books for $9,600 at the end of 2025.
Correct. Now, fast forward to 2026. Those employees actually take their 20 weeks of vacation, but maybe they've had pay raises and now they earn $540 a week.
Ah, okay, so the actual cash paid out is higher.
Precisely. The total cash paid is 20 weeks times $540, which is $10,800. So when they make the payment, they debit reduce the vacation payable account by the $9,600 that was already accrued.
Right.
But they paid out $10,800. That difference, the extra $1,200, $10,800 minus $9,600, gets recorded as an additional salaries and wages expense in 2026, the year the vacation was actually taken at the higher rate.
Wow, so the cost of that time off actually increased between when it was earned and when it was taken. That's a subtle but potentially significant escalating cost for the company.
It really can be, especially over time with wage inflation. And you see similar thinking with sick pay. If it's vested sick pay, you absolutely have to accrue it. If it's accumulated but not vested, accrual is technically optional under GAAP, unless employees are allowed to take it even when they aren't sick, using sick days as personal days. If that's the policy, then you generally do have to accrue it.
It really makes you think about how company policies on benefits directly impact their financial reporting and planning, doesn't it?
Absolutely. It's all interconnected.
Okay, one more piece here before we look at the big picture. Bonuses. How do they fit in?
The bonus agreements are pretty common. Usually performance-based payments, maybe tied to hitting sales targets or profit goals. They're considered additional compensation. And the accounting rule is straightforward. You expense the bonus in the period it's earned by the employee, not necessarily when it's paid.
So if Alex promises her team a $50,000 bonus if they land a huge client, and they land that client in December.
Then in December, even if the cash isn't paid until January, Alex's firm records a $50,000 bonus expense and a corresponding $50,000 bonus payable liability. The obligation is created the moment the condition is met.
Got it. Another liability hitting the books right away. Okay, so we've covered quite a bit. Deductions, employer taxes, compensated time off, bonuses. When a company like Alex's adds all this up, where does it actually show up on their main financial statements? What does it tell an outsider?
Good question. All these different employee-related obligations, the payroll deductions payable, the payroll taxes payable, the accrued vacation or sick pay, the bonus payable, they almost always get classified as current liabilities on the company's balance sheet.
Current liabilities meaning they expect to pay them off relatively soon.
Exactly.
Yeah.
Usually within 1 year or the company's normal operating cycle. It makes sense, right?
Yep.
Taxes are paid frequently, payroll happens regularly, bonuses are usually paid out within months, vacation is usually taken within the next year.
Right.
So if you looked at the liabilities section of Alex's balance sheet, you might see lines like, current liabilities. Salaries and wages payable, say $25,000 for the current pay period. Then payroll taxes payable, maybe $10,000. Vacation payable, that $9,600 we calculated. Bonus payable, $50,000. Add those up. You're looking at $94,600 just in those specific employee-related current liabilities. That gives you a snapshot of the company's short-term obligations tied directly to its workforce.
Wow, $94,600. That really puts it in perspective. It's clearly way more than just the salary figures. So why is tracking this so critical for companies beyond just, getting the accounting right? What's the strategic angle?
Well, it comes down to the fundamental importance of employee-related costs. As we've seen, these add up to significant operating expenses. They directly impact profitability, cash flow, everything. Managing them effectively is just crucial for financial health. But beyond the pure numbers, think about the bigger picture. These costs reflect strategic decisions. In today's world, employees often value benefits, good health insurance, generous vacation time, retirement plans, flexibility just as much, sometimes even more, than the base salary figure.
Yeah, that's definitely true.
So how a company handles these liabilities, how they structure their benefits, it directly impacts their ability to attract and keep the talent they need. It's not just an accounting exercise. It's a core part of their business strategy and competitive positioning. These liabilities can even become a sticking point in, say, a merger or acquisition if the target company has massive accrued leave balances. It's a real financial factor.
That's a great point. Okay, so let's try to wrap this up. Key takeaways from our deep dive today. Employee-related liabilities are this broad umbrella covering payroll deductions, the employer's share of payroll taxes, that tricky compensated absence accrual, and things like bonuses.
And remember the critical difference. Deductions withheld from employee pay are liabilities for the employer, but not expenses. The employer's own payroll taxes, like their share of FICA, FUTA, CIOTA, are expenses and liabilities.
Right. And compensated absences, like vacation, get accrued as liabilities when employees earn those rights, especially if they're vested, based on current pay rates, which can lead to higher costs later. Bonuses hit the expense line and create a liability as soon as they're earned.
And it all typically lands on the balance sheet as current liabilities, giving a clear view of those short-term commitments. Understanding this stuff is really valuable, especially if you're digging into financial statements or studying intermediate accounting.
Definitely. So, maybe a final thought for everyone listening. Next time you look at a job offer, or maybe even glance at a company's annual report, think beyond just the headline salary number. How might you look differently at the total compensation package now, knowing about all these other liabilities, these promises and obligations the company takes on? It's a much bigger, more complex picture, isn't it?
It certainly is much more to it than meets the eye.
Well, thanks for joining us on this deep dive. Hopefully that shed some light on the hidden world behind the paycheck. Keep exploring.